Welcome to my channel, College Guru 2020. Just in case you've not yet subscribed to my channel, this is the right time. Let's take a look at how banks create loans, also known as credit creation. Before we get into the topic with an example, let's try to understand the concept first. Banks create loans only when they get deposits from customers. These deposits, if kept idle, will not generate any income for the bank, just like how we keep money under our pillow. Loans are the main source of income for all banks. However, the entire deposits in banks cannot be advanced as loans. This is where the concept of cash reserve comes into play. So, what is cash reserve ratio? Commercial banks are required to keep a part of the total deposits with RBI as cash reserve. During inflation, RBI increases the CRR, which is the cash reserve ratio, and during recession, RBI reduces it. For instance, the pandemic situation we all are in today due to the novel coronavirus resulted in RBI reducing the CRR to 3% as of November 2020. In our example, to understand credit creation, we shall consider the cash reserve at 20%. Please remember that cash reserve ratio, the CRR, would vary from time to time as prescribed by RBI, the Central Bank of India. Customer, Mr. John, deposits rupees 1 lakh in Bank of India. As per our example, banks are required to keep 20% of deposits in the form of cash reserve with RBI. The balance sheet of Bank of India after the deposit of 1 lakh by Mr. John would be like this. On the liability side, as deposits, you will find 1 lakh. And on the asset side, you find 1 lakh in cash. Bank of India is required to keep cash reserve of 20%, which is 20,000 of 1 lakh, and can advance the remaining 80,000 as loan to businesses and individual customers. All right then, let's suppose Bank of India advances a loan of rupees 80,000 to Maruti Suzuki, who uses this to purchase tires from Apollo Tires. In this example, Maruti Suzuki gives a check of rupees 80,000 drawn on Bank of India to Apollo Tires. Apollo Tires then deposits this check in State Bank of India. As a result, the amount of rupees 80,000 is transferred by Bank of India to SBI. The final balance sheet of Bank of India would look like this. On the liability side, you'll see the deposit made initially by Mr. John of 1 lakh is reflecting, and on the asset side, the cash reserve of 20,000, which is in line with the CRR mandate of RBI, and the loan advance, which is 80,000. SBI has a deficit of rupees 80,000 now, and therefore it has to maintain a cash reserve of 20% of 80,000, which is 16,000, and give away the balance as loan. Therefore, based on the cash reserve mandate by RBI, the Bank of India can utilize rupees 64,000 to give loans. Let's now assume that SBI gives a loan to Aptech Training for purchase of laptops for their training center. Aptech issues a check drawn on SBI for rupees 64,000 to HCL. HCL then deposits this check in ICICI Bank. Now, ICICI Bank has a deposit of rupees 64,000 and can advance loan of rupees 51,200. That is 20% of 64,000 subtracted from 64,000. So 80% of 64,000 is 51,200, which can be given away to its customers. This process will go on until the minimum reserve limit is reached. This is how banks create credit. Feel free to ask me any question on credit creation. I could be reached at 9500117773. In case you're dialing from outside India, please do prefix the international code, which is 91. If you would need notes or explanations like these on banking, insurance, or any such topics, please do let me know. See you soon. Happy learning. Bye bye.